Good morning, everybody, and welcome to this month's sustainability webinar. Now, today we're continuing on our journey through AASB S2. We're looking at Pillar 2, the strategy pillar, with a specific focus on climate resilience and the effects on financial statements. So my name is Aletta Boshoff. I'm the National Leader for Sustainability and also IFRS and Corporate Reporting. If you are wondering why you can't see me today, it is intentional because, as you know, over the last number of months using GoToWebinar, I've been flickering in and out like a bit of a ghost. So I decided that this month we're not going to do that to you. I'll just be a voice, so you can't see me. So BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community, and we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, you can register for our monthly sustainability webinars. As I said, today we're finishing off Pillar 2 strategy, and then next month on the 25th of June, we are looking at Pillar 3, a risk management pillar. We'll do that in June and July. And then in August, we move on to Pillar 4, where we look at tracking your carbon footprint, looking at setting emissions, etc. So today we finish Pillar 2 and then we move on to Pillar 3 and 4. We also have monthly IFRS and corporate reporting webinars. Now, the next webinar on the 18th of June has a link with sustainability because we're looking at accounting for climate and other uncertainties in financial statements. So we are very specifically linking climate-related risks and opportunities that we disclose under AASB S2 with your financial statements. So that is an IFRS webinar not to miss. We're also running quarterly carbon accounting masterclasses. Now, next week on Wednesday, the 4th of June, I'll be presenting the next carbon accounting masterclass. It's a whole day from 9 to 5. We take breaks during the day so you don't feel overwhelmed or too stuck to your screen. If you still want to register, you can still register using that link on the screen. So please join us for that. Then I've just returned from Europe where I've attended our BDO Global Sustainability Conference. Before the conference, we had a 2-week period where we asked clients to take a survey, clients or our webinar attendees to take a survey and tell us about your perspective on sustainability reporting and the importance for your organizations. We received a lot of feedback from Australia. However, BDO Global decided to relaunch the survey and give us another 2 weeks to get even more responses. I was really proud of all the responses we received from Australia. Some other countries didn't get great response rates, but we don't want them to overtake us. So please, if you could please complete this survey. It's a very short survey, but we really value your feedback and your input. And we will share the results on this webinar shortly, on one of our next webinars shortly. Now, this webinar is the second part of our webinar on strategy. So AASB S2 has 4 pillars. The second pillar is the strategy pillar. And last month we had part 1. Today we're finishing off that strategy pillar in part 2. Before we do that, I would like to talk about the latest developments, as we always do on these webinars. Now, the very latest development is that ASIC announced its financial reporting and audit focus areas for 2025-2026 financial years. And in those focus areas, they specifically called out sustainability reporting standards and said, We acknowledge that AASB S2 will be mandatory for Group 1 entities with financial years beginning on or after 1 January 2025, and impacted entities should begin work as soon as possible if they've not already implemented plans and procedures to meet these requirements. Then, in that second last paragraph on the screen, ASIC indicated that they will review 31 December 2025 sustainability reports as part of their surveillance program, and they will share their observations with the market to assist preparers. And so all of our clients and other entities, attendees of the webinars who are preparing 31 December 2025 reports, we will be the first in Australia preparing those reports. ASIC will look at that. And we will actually be the first significant economy looking at IFRS S2. So even at our recent conference, everybody's saying, Aleda, we'll be looking at what you'll be doing in Australia. And then they also flag that preparers should look at Regulatory Guide RG280, which was published on the 31st of March. Now, this ASIC release was only published 2 weeks ago, so it's really hot off the press. I've got a link to the ASIC media release, and also here again a link to the ASIC Regulatory Guide 280. So that's for the latest news. Because this webinar is a part 2 on strategy, I thought we should start by doing a quick recap of what we've discussed last month in part 1. Now, last month we said when you look at climate-related risks and opportunities, there's 2 critical parts to consider, and that is the climate science and climate policies. And we stepped through quite a bit of the climate science and climate policy. Around climate science, we've acknowledged that the Intergovernmental Panel of Climate Change have issued their most recent report, Report 6 in 2023, and we know that AASB S2 specifically refers to the Intergovernmental Panel of Climate Change and their Report 6 as issued in 2023. So we've looked at some extracts out of this report. This is a very important report to have a look at around climate science, what the expectations are globally, but also what it would mean for Australia. It's a really good read. Then we said for Australia, very specifically, we've got the CSIRO report that was actually issued in 2024, so last year, the state of climate, taking a close look specifically at Australia. So these 2 reports, very important to inform your thinking around the climate science, and then how does that convert into climate risks and opportunities for your business. Now, one of the other things to consider would be climate policies. Now, to me, this screenshot is an or extract from the IPCC report, is a really powerful one because it's looking at the implemented policies and where that would take us. So if we look at climate change and the currently implemented policies, we are heading for, a climate, we're looking at a warming of around 3.2 degrees. And the range is between 2.2 and 3.5. So we would need a lot more climate policies if we are going to reduce global warming to 1.5 degrees or even 2 degrees. So you can see based on current policies, overshooting that target by a lot. So that's just a connection between climate science and already implemented policies. We also said, really important for the purposes of AASB S2 in the strategy part, is that entities conduct a climate risk assessment or a risk and opportunity assessment, which then provides valuable input into scenario analysis, and again, which provides valuable input into financial modeling of the impact on financial statements, so that you do this in a particular order. I think the other thing to remember, often when there's a new accounting standard, one would say the data already exists somewhere in the financial statements, the general ledger of the business. It's just maybe the way we disclose it or present it that's a bit different. So the data exists. Um, AASB S2 as a sustainability disclosure standard is a bit different in that the data don't already exist, right? So you have to conduct a climate risk assessment to generate data. Then you have to perform the scenario analysis to generate data to disclose, and you have to do financial modeling. So this is not existing information that's just disclosed. This is new projects that have to be conducted to generate data to meet the disclosure requirements. Um, then we also had a look last month again at what is a bit of an overview of climate risks and opportunities. And this is an extract from the TCFD, where we looked at policy and legal risk. We looked at technology risks, market risks, so changing customer behaviors. We looked at reputation risk. And we then also looked at physical risk, whether it's acute or chronic. If you look at opportunities, we looked at opportunities around resource efficiency and energy sources, products and services, markets, and resilience. So a bit of a recap on climate risk and opportunities. And then very important, all these risks and opportunities will impact the strategic planning of the business, will impact the risk management, and ultimately flow through to have a financial impact on income statement, cash flow statement, and balance sheet. So that's what we did last month, and we're now continuing on this strategy journey. So an overview of AASB S2. We're looking at climate-related risk and opportunities. The focus is on our primary users of financial statements, so investors, financiers, current investors, financiers, potential future investors and financiers. And we're trying to give them information that assists them in making decisions around whether they will be providing resources to the entity or not. We also say when we look at climate-related risk and opportunities, and the information to disclose, we would disclose those risks and opportunities that could reasonably be expected to affect an entity's cash flows, its access to finance, or it would impact its cost of capital, and over the short, medium, or long term. And it's that time period and the time horizons that makes it really hard to argue that a business will never be subject to climate-related risks and opportunities, because a business might argue that they're not subject to climate-related risk and opportunities over the short term. They might even argue not subject to climate-related risk and opportunities over the short and medium term. But how can you assess that you will not be subject to climate-related risk over the long term? So, the objective of the standard and the scope is really broad. The other thing that I thought would be interesting is to look at a bit of an overview of the disclosure requirements that are outlined in AASB S4. Now, as we've said previously, there are the 4 pillars, the governance pillar, and you'll see at the bottom there are 9 disclosure requirements. We've discussed that a couple of months ago. If you look at pillar 2, strategy, which we've been discussing over last month and this month, there are 56 disclosure requirements. Then next month or the next 2 months, when we look at risk management, 9 disclosure requirements. And then when you get to pillar 4, the metrics and targets, your carbon footprint, etc., 44 disclosure requirements. You'll see I've added a 5th column, and that is the general requirements from AASB S1. Although AASB S1 is a voluntary standard in Australia, in Appendix D of AASB S2, they've picked up a number of disclosure requirements from AASB S1 that should be applied when you do disclosures under AASB S2. So one could see it as somewhat of a fifth pillar, picking up relevant disclosure requirements from AASB S1, and there's 31 disclosure requirements that's picked up that way. And we'll address that as well, not in today's webinar, but not to forget about them, we will address them in one of our webinars. So if we look at that second pillar, where we look at strategy, the objective of climate-related financial disclosures on strategy, this particular pillar, is to enable users of the financial reports to understand the entity's strategy for managing climate-related risk and opportunities. So once we've identified these risks and opportunities, how do we manage these? And what are our risk mitigation activities? Now, the strategy pillar on its own can be split into 5 different aspects, and we've touched on it last month as well. The very first aspect is climate-related risk and opportunities, and that's outlined in paragraphs 10 to 12. Now, that was the focus of what we've done last month, because identifying climate-related risk and opportunities, understanding climate science, understanding climate policies and how it turns into risk and opportunities is an absolute foundational aspect of the standard. So we've looked at that. Numbers 2 to 5 are where we look at the business model and value chain, where we look at strategy and decision making. Number 4, where we look at the financial position, financial performance, cash flows. And finally, number 5, we look at climate resilience. So we'll be looking at numbers 2 to 5 today, all part of strategy. So the first one, where we look at climate-related risks and opportunities, the disclosure requirements, and I've put them here, the disclosure requirement, the reference, where did I get it from, which paragraph, and an assessment column. So if you want to make some notes to what extent you've dealt with this as an organization. So here you can see around climate-related risks and opportunities, which we've discussed last month. The first one is you have to disclose information so the users can understand these risks and opportunities that could reasonably expect it to affect the prospects. Particularly in disclosure number 2, you have to describe these risks and opportunities that's expected to affect the business, so describe it. And then in the third one, you have to explain for each risk and opportunity whether the entity considers this risk to be a climate-related physical risk or a transition risk. So it's not just here are our climate risk, is it a physical risk or a transition risk? Number 4, it says, has the entity specified for each risk and opportunity that they've identified over which time horizons, short, medium, or long term, the effects of these risk and opportunity could be expected to occur. So here's this reference to a time horizon. And in number 5, they talk about the entity has to explain how we've defined short-term, medium-term, long-term. Because the standard doesn't tell us what short-term means and what medium-term means and what long-term means. Each business will define that based on their own business and their planning cycle and their strategy. So how have you as a business defined short, medium, and long term? And how do you expect these climate risk and opportunities to play out over that short, medium, and long term? And then also, very important, number 6, the way you've defined short, medium, and long term, how is that linked to the planning horizons that you use for your strategic decision making? So quite interesting disclosure requirements around risks and opportunities and that time horizon. If we go on continuing to coming back here. In number 1, talking about risk and opportunities, that red block that I've added there, in order to meet the disclosure requirements around climate-related risk and opportunities that we've just talked about on the previous slide, the only way you can meet those disclosure requirements is to conduct a climate risk and opportunity assessment. That's the building block you need for those disclosures. Now, time horizons I've called out, and we often receive a lot of questions around time horizons. So this short, medium, long term, how do we do it? So what I've done, I've included some extracts from the TCFD guidance on scenario analysis. On the left-hand side is an extract from page 17 and the right-hand side, page 18. So here on the left-hand side, that second paragraph, in setting climate-related scenarios and the time horizons, companies should challenge their thinking about traditional planning horizons, which are often too short. Scenario time horizons are typically longer than many corporate planning horizons. Scenario time horizons that are too short may result in simple extrapolations of current thinking and trends, and therefore not reveal the information that's needed to assess the resilience of the company's climate-related strategy. Often climate-related risk and opportunities don't eventuate over the short term, and therefore it's important to also look over that longer term and challenge your thinking. Then on the right-hand side, they specifically say you should consider time horizons that are compatible with the company's capital planning and investment horizons, and also that's compatible with the useful life of major company assets. So if you've got major company assets with a useful life of 20 or 30 years, your scenario analysis should be compatible with that. Also, the second bullet point there, the time horizon should be harmonized or anchored with those, and this is an important point, national and international climate policy communities. So, for example, if in Australia government is committed to be net zero by 2050, how do you align your scenario analysis to that commitment? So harmonizing company scenario time and horizons to key years and the cycle of the climate policy community can provide an important anchor. So look at that as well. Then again, if you look at the guidance on page 75, they talk about that an entity should determine the time horizon over which the focal questions will be considered. So when you do scenario analysis, you come up with focal questions. What's those time scenarios again? And again, they talk in the second paragraph, a company may want to align scenario time horizons with those used in scenarios of the climate research community. So it's another thing to think about. So if you look at CSIRO, if you look at that Intergovernmental Panel on Climate Change, what scenarios are they researching? Potentially we should align to those. And then again, in the last paragraph, using a time frame that extends only a few years into the future fails to take into account important questions whose answers might depend on climate change effects that will become perceptible several years or decades down the line. So everything that we're reading in the guidance is warning us in taking to a short-term focus on our time horizons. Again, if you look at the guidance on page 49, I found this very interesting diagram talking about time horizons. And you can see here we have at the bottom the present, and then they say potentially, and this is not definitive, but potentially, if you look over the next 2 years, That's where we formulated operating plans and budgets. So that's financial implications, estimates or actual climate change impacts on current revenues and costs, on our budgets, on our values, our assets, value of assets and liabilities. And then they say maybe when you start to look at 2 to 5 years, this is aligning to your project planning, your financial analysis of strategic projects and initiatives. You're thinking about your financial strategy. Maybe that's a 2 to 5 year horizon. If you look at 5 to 10 years, maybe this is strategic planning informed by scenarios around capital planning. So maybe 2 to 4 years are projects, and maybe capital is around 5 to 10. And then more than 10 years often is more strategic thinking informed by scenarios. I think what's important to note with the time horizons is that your long-term time horizon is always open-ended. So it's more than 10 years or more than 20 years or more than 30 years. It doesn't stop at a particular point in time. So it's open-ended. And you can see it in this diagram again. So just an example of what it could look like from the same guidance. So those time horizons are really important. If we then look at business model and value chain, the second part, disclosure requirements that we see here, has the entity disclosed information to enable the users to understand the current and anticipated effects of climate risk and opportunities on the business model and value chain. So I've highlighted in two different colors here. In green, it's the current and anticipated effects. So you have to look at current effects and future-looking anticipated effects, and you have to look at that climate risk and opportunities will have on your business model, but also your value chain. So really important to unpack all of that. So has the entity disclosed a description of these current and anticipated effects on the business model and the value chain? You have to describe it. And has the entity disclosed of a description of where in its business model and value chain these risks and opportunities are concentrated? Right? So, for example, we've got a concentration of climate-related risk in a particular geographical area, or we've got a concentration in certain facilities or certain types of assets. So that concentration aspect is important. So 3 disclosures in this part. Now, reading that, talking about business model is defined in the Appendix A, and it says it's an entity's system of transforming their inputs through its activities into outputs and outcomes that aims to fulfill the strategic purpose and create value for the entity, and hence generate cash flows over the short, medium, and long term. So remember, what is the current and anticipated impacts of climate-related risk and opportunities on this business model, on your ability to generate value, to generate cash flows over short, medium, and long term. That's what they mean by business model. But then they also say you have to look at current impacts and anticipated impacts on the value chain. And this is an interesting one because it's the full range of interactions, resources, relationship relating to the entity's business model, as well as the external environment in which it operates. So the value chain is the interaction, resources, relationship that an entity uses and depends on to create products or services. It's from conception to delivery, consumption, and end of life. It reminds me of what we see in the value chain of the greenhouse gas protocol. They call it cradle to grave. So value chain is cradle to grave interactions, resources, relationships within the operation. So examples, it could be HR, it could be supply chain, it could be marketing, it could be distribution channels, it could be materials and service sourcing, it could be product and service sale and delivery, it could be financing, it could be geographical, geopolitical, regulatory environments in which the entity operates. So it's the whole value chain. It's also the external environment. So when we do a climate risk assessment, it's not just looking at the entity in isolation, it's looking at the whole value chain of the entity. It's looking at the external environment in which the entity operates to identify these risks, these opportunities, and consider current impacts, but also anticipated future impacts. Now, to come up with the impact on your business model and your value chain, you need to conduct a scenario analysis and you have to perform financial modeling. So again, what are the building blocks to get to these disclosures? Scenario analysis, financial modeling. Remember in number one, or pillar number one there, we've already done the climate risk and opportunity assessment. But now we go further than that. How would those risks and opportunities impact our business model, impact our value chain? And this is where we need that scenario analysis and modeling. If we go on to the third aspect and we look at strategy and decision making, now here we've got a lot of disclosure requirements. So again, I've highlighted some key aspects. So the introductory disclosure here is, has the entity disclosed information to enable the users of general purpose financial reports to understand the effects of those climate-related risks and opportunities on the entity's strategy and decision-making, including information about its transition plan. So in this part of the disclosure, we look at strategy, decision-making, transition plans. So in the previous part, we looked at business model, value chain. Here, the focus is slightly different. How does this impact our strategy, our decision-making, our transition plan? Now, there's detailed disclosure requirements below that. So has the entity disclosed how the entity has responded to and plans to respond to climate risk and opportunities in its strategy and decision making? So the one is in the past, how have we responded? And then future looking, how will we respond or plan to respond? Number 12, has the entity disclosed how the entity plans to achieve any targets it set and the targets it is required to meet by law or regulation? Now, this is an interesting thing in Australia because in disclosure number 12, you might not have set any climate targets. So, you don't have to worry how you're going to achieve it. If you've set targets, how do you plan to achieve it? But the second part is interesting. Targets that's required to be met by law or regulation. So in Australia, if you are subject to the safeguard mechanism and you have to reduce your emissions by a certain percentage every year, and that's a regulation that applies to you, how do you plan to achieve that? Or for Australian businesses where government wants us to be net zero by 2050, how are you going to achieve that? So that's a target that you haven't set, but government law regulation has set it on your behalf. How are you going to achieve that? So that's just something to remember. And then, has the entity disclosed, again, current and anticipated changes to its business model and also its resource allocation to address these risks and opportunities? Examples could be, plans to manage or decommission certain carbon-intensive operations. Maybe you've got resource allocations resulting from demand or supply chain changes. Maybe you've got acquisitions or divestments as a result of these risks and opportunities. but you have to disclose all of those. Additional disclosures, extensive disclosures. You have to disclose your current and anticipated direct mitigation and adaptation efforts, but also your indirect mitigation adaptation efforts. You have to disclose any climate-related transition plan the entity has, information about key assumptions that you've used to develop the plan, and what are the dependencies of that plan. You have to disclose how you plan to achieve your targets, as well as your greenhouse gas emissions targets. You have to disclose how the entity is resourcing currently and plan to resource these activities in future. And then also you have to disclose quantitative and qualitative information about these progress of these plans. So maybe a few things out of those disclosures that one should look at. In Appendix A, there's a definition of climate-related transition plan, and it says it's an aspect of an entity's overall strategy that lays out the entity's targets, its actions, or its resources for its transition towards a lower carbon economy. So if they talk about what are your climate-related transition plan, it could be your targets, your actions, your resources to go to this lower carbon economy. So that's specifically defined. So what are we talking about here? It's really connecting these risks and opportunities with your strategic planning. So how does it impact your strategy? So to identify risk and opportunities in isolation is no good. How does it influence your strategy and your strategic planning? Now, again, I'm trying to today look at the disclosure requirements and then work back. If I have to disclose all these things and all this information don't exist, what do I have to do to generate this information in order to meet the disclosure requirements? So it's a little bit of a top-down approach. So again, if you want to look at your strategy, your decision making, that information, the current impact, future impacts, comes from your scenario analysis and financial modeling. So in the fourth area, we look at financial position, financial performance, and cash flow. So financial position in your balance sheet, your financial performance in your profit and loss, and your cash flows. Here you can see again the disclosure requirements, extensive. And I've highlighted a few things again for you. So in disclosure number 20, within strategy, has the entity disclosed information to enable users to understand the effects of climate risk and opportunities on its financial position, financial performance, and cash flows for the reporting period, which means the current reporting period? And then the second part, the effects or the anticipated effects, so future effects on financial position, performance, cash flows. And it's not just future effects over the short term, again, short term, medium term, and long term. So it's the current position, also the future position over short term, medium term, long term. And remember, long term, as we discussed earlier, is open-ended. And then you have to take into consideration how these risks and opportunities have been factored into your financial planning. So in disclosure 21, a little bit of additional explanation around current financial effects, the current reporting period. Number 22 is looking at anticipated financial effects. And then in 23, they say, remember, you have to disclose quantitative and qualitative information. So quantitative could be a single amount or it could be a range, and then qualitative information as well. Here you can see a few other things. They explain quantitative, explain qualitative. Again, the reference to short, medium, and long term. And then the very last one on this screen, number 21, if an entity determines that it need not provide quantitative information about the current or anticipated financial effects of climate-related risk or opportunity, applying the criteria set out in AASB 2 paragraphs 19 to 20, has the entity explained why it has not provided quantitative information. So this is all about, a lot of people are asking, can I have qualitative information only? You have to have qualitative and quantitative information. But if you cannot, or if you meet the criteria in paragraphs 19 to 20, and therefore you don't think it's appropriate to provide quantitative information, have you explained why not? And then you'll see disclosures 30 and 31, similar. If you've not provided that quantitative information, have you explained why not? Have you provided qualitative information, etc.? So that's again disclosure. Again, if you're looking for the impact of risks and opportunities on your balance sheet, your P&L, your cash flows, that's why we're doing the scenario analysis and financial modeling. Now, a big part of your strategy disclosures are around climate resilience. A number of disclosures. And it talks about, in number 32, has the entity disclosed information to enable users to understand climate resilience of its strategy and its business model? Coming back to strategy and business model, how resilient, climate resilient is this strategy and business model? And then there's a number of disclosure requirements specifically looking at climate-related scenario analysis. So has the entity disclosed whether it used climate-related scenario analysis to assess resilience, using an approach that is commensurate with the entity's circumstances? And that then expands into a lot of disclosures. Has the entity disclosed the assessment of its resilience at reporting date? Have they disclosed the implications of its assessments for strategy and business model? Has the entity disclosed how it would need to respond to these effects in the scenario analysis? Has the entity disclosed significant areas of uncertainty that they've considered in their climate resilience, etc.? So a lot of specific disclosures around climate resilience. And then it goes on, and you can see here I've highlighted the words climate-related scenario analysis the whole time. The entity have to disclose how and when they carried out that scenario analysis. The entity has to disclose which climate-related scenarios it used for its analysis. The entity have to disclose whether the analysis included a diverse range of scenarios, etc. So a lot of disclosures around scenario analysis. And then the last few disclosures, the entity have to disclose key assumptions around climate-related policies in the jurisdictions in which the entity operates. So it's not just where the head office is, but also the climate-related policies where the suppliers are, climate-related policies where the customers are based. Have you considered and what assumptions have you made about macroeconomic trends? What assumptions have you made about national or regional level variables? And number 54, the assumptions around energy use and mix. What assumptions have you made about technology? So when you look at all these disclosures, again, working back, when you do a scenario analysis, it's telling us that you have to consider macroeconomic trends. You have to consider national or regional level variables. You have to consider energy usage and mix and technology. And then after you've considered it, then you have to provide all those details. So again, if we look at all those disclosures and we go back, the appendix to AASB S2 defines climate resilience, and it says it's the capacity of an entity to adjust to climate-related changes, developments, uncertainties. So how resilient is the entity? What's the capacity of the entity to adjust? Climate resilience involves the capacity to manage the risks, the capacity to benefit from opportunities, the ability to respond and adapt to transition risks, and also the ability to respond and adapt to physical risk. And they also say your resilience includes your strategic resilience, but also your operational resilience. So there's two parts to it. So you can see again, when we do a scenario analysis, when we do financial modeling, we should consider all of this at a strategic and an operational level. The following is an extract from AASB S2 paragraph 22, and it specifically says the entity shall use. Now, most of AASB S2 says shall disclose or shall describe. In this particular paragraph, and this is why I called it out, it says the entity shall use climate-related scenario analysis. So to perform scenario analysis is not optional. You shall use scenario analysis to assess your resilience. And then you shall disclose your estimates, your assumptions, etc. So very important, you shall use climate-related scenario analysis. And in providing quantitative information, the entity may disclose a single amount or a range. So I just wanted to call that out because a lot of people would think that AASB S2 is just about disclosures. It's a little bit more than that. It actually mandates the use of scenario analysis as an example. The other thing I often get a number of questions on is, if we do scenario analysis, how do we do it? Where do we get guidance? And a lot of people are confused by the relevance of the TCFD guidance. Now, this is again an extract from AASB S2 and from the appendix. And at the bottom, it's got this footnote. It says this application guidance, so that is Appendix A of AASB S2, which is a mandatory and an integral part of AASB S2, draws on the range of practice outlined in documents published by the TCFD, including the technical supplement, the one in green, and the yellow one, the guidance on scenario analysis. So those two documents are still relevant and still very important when you conduct scenario analysis, which is a mandatory thing. So the technical supplement is on the left and the right-hand side is the guidance. And that's where I get all the information from for this webinar and other webinars on scenario analysis. So if you look at this appendix around climate resilience, Appendix B, a few things to look out for. You can see that they talk about that an entity use a scenario analysis that is commensurate with its circumstances. So what does that mean? You use an approach to climate-related scenario analysis that allows you to consider all reasonable and supportable information that is available to the entity at the reporting date without undue cost or effort. Now, an organization should be careful to not jump to this and say it's not available, I don't have to do it. No, reasonable, supportable information, undue cost or effort. So you should put in some cost and effort, but not undue cost and effort. They specifically tell us the factors that the entity shall consider when they assess their circumstances, because it has to be commensurate to our circumstances. So how do we assess that? what factors do we consider to work out what's an appropriate approach, and what are some additional factors to consider? So I'll look at some of them. Now, I've highlighted the word shall again, because this is not shall disclose, this is shall use, shall consider, shall assess. It's mandating what we do in order to generate disclosures. So an entity shall use an approach that's commensurate with its circumstances. And to decide what approach that is, you shall consider your exposure to risks and opportunities, and the skills, the capabilities, the resources that's available to the entity. And an entity shall assess its circumstances each time it carries out the scenario analysis. So, for example, if you carry out your scenario analysis every 3 years because you want to align it to your strategic planning cycle, every time you do it, you will consider, what is an appropriate approach, what are the appropriate skills, what's our latest skills, capabilities, resources at that time. You don't assess it at a particular time and don't revisit it in future. Then if you look at climate resilience again, an entity shall consider its exposure to risk and opportunities. This consideration provides essential context for understanding the potential benefits of using a particular approach to do scenario analysis. So, 2 examples. If an entity has a high degree of exposure to climate-related risks, then a more quantitative or technical, sophisticated approach for scenario analysis would be beneficial. Users of general purpose financial reports would be less likely to benefit from quantitative or very technically sophisticated scenarios if the business is exposed to few or relatively less severe climate risks. So important at the bottom, with all things being equal, the greater the entity's exposure to climate-related risk or opportunities, the more likely it is the entity would determine that a more technically sophisticated scenario analysis is required. So, you assess your risk and opportunities, and that will impact the complexity of your scenario analysis. If you look at your skills, your capabilities, your resources, the entity shall consider the available skills, capabilities, resources when they decide on an appropriate scenario analysis. You will look at internal and external skills and resources. Again, if an entity is just starting the process, and then it might be unable to do a very quantitative or technically sophisticated approach without undue cost or effort. However, if the resources are available to the entity, then it will be able to do a more complicated scenario analysis. Here, continuing on the theme, when an entity repeats that scenario analysis, it's likely to develop skills and capabilities that will ensure that they now have more skills. They can do a more comprehensive scenario analysis. So an example is an entity in an industry where climate-related scenario analysis is an established practice. So often that we would see in extractives and in mineral processing. They would be expected to have strengthened its skills and capabilities through that experience and do a more quantitative, comprehensive, technical scenario analysis. So definitely higher expectations on the extractives industry. Again, the word shall, an entity shall determine an approach that enables it to consider all reasonable, supportable information without undue cost and effort. The determination of that approach shall be informed by its skills, its capabilities, and also making such a determination involves selecting your inputs into your scenario analysis and also making analytical choices on how you conduct that scenario analysis. So again, some information around your judgment on your time horizons, etc. Looking at selecting inputs, I think this is an important one. When an entity selects the inputs that they use in the scenario analysis, the entity shall consider reasonable and supportable information, so scenarios, variables, other inputs, again, available without undue cost and effort. The inputs used in scenario analysis might include information that's qualitative or quantitative, and it can be obtained from an external source or it could develop internally. So there's publicly available climate-related scenarios generated by IPCC. Authoritative sources is important. That describes future trends and pathways, etc. So the emphasis, authoritative sources that should be used. Again, if you're looking at your inputs, again, you would look at an entity shall have a reasonable and supportable basis for using a particular scenario or set of scenarios. So, for example, an entity with operations concentrated in the jurisdictions where emissions are regulated or likely to be regulated in future might determine it's appropriate to carry out an analysis using a scenario consistent with an orderly transition to a lower carbon economy, similar to Australia. So just examples of things you could think about. Again, an entity shall prioritize its analytical choices to make sure that you consider reasonable, supportable information. Quantitative information will often enable an entity to carry out a more robust assessment of its climate resilience. However, qualitative information, including that scenario narratives, either alone or combined with quantitative data, can also provide a reasonable and supportable basis. Again, an entity shall determine its approach to climate scenario analysis based on its particular circumstances. So it's not a one size fit all. And remember, your circumstances can change over time, and therefore your approach to scenario analysis could change over time. You could use some simpler approaches initially, and as you get more experience, you could use more complicated scenario analysis in future. So a lot of guidance in Appendix B on scenario analysis, but it's important, and that's why I've included all those paragraphs. There's a lot of reference to shall. You shall do the analysis, you shall consider the following, you shall look at authoritative guidance, etc. So the first part of strategy, you need to conduct a climate risk and opportunity assessment in order to look at the current and anticipated effects on your business model, your value chain, your strategy, your decision making, your financial position, financial performance, your cash flows. In order to consider your climate resilience, you need to conduct, and it's mandatory to conduct, a scenario analysis and perform some financial modeling. Now, when we look at scenario analysis and conducting a scenario analysis, I've said earlier, we've got the two guidance documents from the TCFD. And I also want to remind you that last year I did a particular webinar on scenario analysis. So if you look at the 2024 series on our website, more or less at the middle, assessing climate using climate-related scenario analysis. You can have another look at that webinar. It was August last year, and I've got links in there. You'll see that the TCFD is talking about if you're looking at applying scenario analysis to climate-related risk and opportunities, scenario analysis is that third part. Your first thing is your governance, then you look at your risk and opportunities. Your third thing is the scenario analysis, which then leads to an evaluation of business impacts, how you would respond, and ultimately your disclosures. So that red block, the scenario analysis, if you want to unpack that even further, in the technical guidance document, they break it down into 6 particular steps on how to do it. You establish your organizational requirements, you assess your external environment, you formulate your focal question, you define your time horizons, you identify your driving focus across social, technology, economic, environmental, political. You rate and you rank your driving forces. Then you draft your narrative for each scenario. And remember, in Australia, we've got the 2 mandatory scenarios per legislation, the 1.5 degrees and 2.5 degrees. Then on the right-hand side, step 5, you quantify the scenarios where necessary and possible. You check your scenario quality. You draw conclusions and develop strategic options, and then you identify finally significant signpost metrics to monitor future developments. So again, this is from the technical guidance, exactly how to do that scenario analysis. When you perform your financial modeling, this is this last impact. We usually get our corporate finance people involved, where we say, now that we've looked at the risk and opportunities, now that we've considered the impact on strategy, now that we've done our scenario analysis, we've considered our risk management, what are the financial impact in the current year and anticipated financial impact over short, medium, and long term. And it's the impact on income statement, cash flow, and balance sheet. So next steps. So today I did a top-down approach. These are the disclosure requirements required for Pillar 2 strategy. And therefore, what do you have to do as next steps to generate information, not date, but data for strategic disclosure requirements? You have to do a climate risk assessment and have it documented and audit ready. You have to do a scenario analysis, have it documented and audit ready. And there's a lot of mandated aspects around that scenario analysis outlined in Appendix B. And then there's financial modeling, which corporate finance helps us with. So how BDO can help? First of all, in our June webinar, we'll look at Pillar 3, risk management. We'll do Pillar 3 over 2 months again. So there's part 1 next month, and in July, part 2. We can help you with sustainability reporting, with the mandatory reporting or voluntary reporting. And please reach out to Tom Hogbin or me or Ashley Hoodley or Kevin Frobers to help you with getting ready for AASB S2. Thank you very much for joining this webinar today. Please complete that survey, the BDO Global Survey. We would love to get your feedback, and we'll speak again in June. Have a lovely day.